Welcome to this week's market update. Today we'll review key economic developments from the past week, highlight upcoming events, provide insights into the current economic outlook and technical analysis. Okay, let's dive right in. Last week was another eventful week. Markets experienced some volatility with a sharp down day for the second Monday in a row. The Nasdaq and S&P 500 were down around 2% intraday before recovering somewhat. Tuesday was marked by a rebound with up markets. The market remained relatively static until Friday, which experienced a reversal day, opening up only to have a down day. In this case, the Nasdaq and S&P 500 fell 1.4% and 1% respectively. The U.S. released employment data last week, noting the economy added 143,000 jobs. This was slightly under expectations, but resulted in an unemployment rate of 4%. The Bank of England reduced its benchmark interest rate from 4.75% to 4.5% and, more interestingly, cut its 2025 growth forecast substantially, citing inflationary pressures. The big news of the week continued to come from the new Trump administration. Economic and political news continues at a breakneck pace. U.S. tariff announcements were swift. However, several were quickly postponed as foreign governments quickly offered concessions. Elon Musk continued in earnest through Doge with major announcements including its intention to close USAID. Of course, the opposition has filed lawsuits to stop these efforts, signaling a dogfight going forward every step of the way. We'll be keeping a close eye on this one. This upcoming week, there are a few key reports. On Wednesday, the Consumer Price Index, or CPI, will be released at 8:30 a.m. Eastern Time. Analysts are expecting a 0.3% increase. This is one of the key factors that provides insight to the Federal Reserve in their determination of policy and potential rate cuts in the future. So this one could move markets, although absent a crazy surprise, not likely to be earth-shattering. The Producer Price Index report is due Thursday at 8:30 a.m. This one relates to wholesale inflation trends, but is less likely to move markets substantially on the heels of the CPI data. Friday at 8:30, retail sales data will be released, offering a glimpse into consumer post-holiday spending. Considered a measure of the consumer sentiment and overall economy, a 0.4% increase is expected. Again, not likely to move markets much by itself. This week there are earnings due from blue chips McDonald's, Coca-Cola, and Cisco. Other notable ones include Shopify and Robinhood. The U.S. economy is expected to grow 2.3% in 2025. On the surface, this figure looks okay, even if it's below the long-term average of 3.16%. But how strong is this figure really? Whether this figure is based on fundamentals of the economy or overinflated by governmental expenditures will become clear soon. Think trillions of approved spending just in the last 4 years, including the $1.7 trillion Consolidation Appropriations Act in 2023, or the infamous Inflation Reduction Act of 2022, for an estimated $739 billion, or Biden's first monster, the $1.9 trillion in the American Rescue Plan Act of 2021. All of these, on top of the normal bloated spending of the government, led to outsized gains in GDP and continue to artificially raise the economic growth rate. In 2021, as government giveaways took root, GDP grew 5.1%. The bottom line is that this growth figure is likely a direct result of governmental spending. Now, however, President Trump and Elon Musk are looking closely at all of the governmental programs to cut, streamline, and/or modernize the U.S. government. A monumental effort, to be sure. The initial results, the buyout of 60,000 employees, was a fast start, and the closing of USAID make it clear they are not messing around. They will reduce governmental expenditures in a large way. The only question is how long it will take and whether they will have enough time before Trump's next term ends. But what does this really mean for the economy? Reducing the staff will increase the unemployment rate and will certainly be felt personally if you lose your job, but is likely to have only a small negative impact on the overall economy. Remember when the entire government shut down for 30 days in Trump's first term? You might not, because basically no one noticed. The bigger impact will be from the elimination or reduction of direct payments. Taking away the golden goose will undoubtedly negatively affect the economics of those on the receiving end, like third-party contractors or service providers. Other cuts could have immediate impacts across the globe as foreign players lose their hundreds of millions of dollars from Uncle Sam. Less money means less spending around. How deep this well is, nobody knows. So we'll keep an eye on this. But not all news is bad news for the economy. One positive effect of money not spent is that the government doesn't have to borrow more. This means that over time, debts are reduced and interest expense gets lowered. Obviously, this isn't something that is going to move the needle too much initially, but could stop the increasing costs of longer-term debts we've seen as Treasury rates have been on the rise. Long-term, less debt and a balanced budget are great things for the U.S. Combined with reduced regulation, the country could be on a path to extraordinary growth over the long term. Let's take a look at how all of this noise is playing out in the technical analysis. We've seen volatility elevated as daily news and data hit. The SPY chart shows the long-term trend remains intact since October 2023. The near-term action has been choppy with the last 2 weeks following near-identical patterns. Even though the MACD remains slightly positive, the reversal day we had Friday indicates that we can expect to test and likely break those lows on Monday, perhaps with a gap down. Key levels to consider for SPY, below 589 on the downside, could signal a bearish or sideways trend. A close above the 610 level will confirm a continuation of the uptrend. The Nasdaq is following a near-identical pattern, maintaining the same bullish channel and in a similar consolidation phase. Like the S&P, the MACD is positive, but the reversal day on Friday is likely to weigh in early this week. A breach of QQQ below the 500 level would indicate a potential break of the channel. A close above 540 would signal continued upward momentum. Okay, well that does it for now. We'd love to hear from you, so please let me know what you think in the comments. If you found this material valuable, please like and subscribe to the channel. It's a big help. Thank you for watching. Until next time, good luck out there. As always, the information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how these securities align with your financial needs. Consult with a financial professional if needed.